Hi, I'm Economist Peter Navarro, and the obvious question any forecaster always tries to answer is, just where is the economy headed over the next 6 to 12 months? But over the years, I've found that the only way to really answer that obvious question is to first address a series of more subtle ones, like which way are interest rates and bond prices headed? As I'm sure you know, bond prices move inversely to bond yields, and bond yields typically rise only when the economy is expanding at a healthy clip. Because this is so, the bond market is a great leading indicator of the economy. To follow this indicator, I very closely watch an exchange-traded fund with the stock symbol TBT. TBT is a double short sell of the long-term bond, so it only goes up in price when bond yields are rising and bond prices are therefore falling. From a big picture forecasting perspective, that means when TBT is rising, that's a great leading indicator of an economic expansion. Of course, the problem these days is that, as this chart shows, TBT has been in a sustained downward trend since February of 2014. You really don't have to know anything more about forecasting to know from this picture that the prospects for a strong global recovery remain uncertain at best and dim at worst. As to why TBT is in a sustained downward trend, it's certainly not because the U.S. economy is weak. In fact, America is the brightest economic light now shining on today's global stage. No, the real problem has much more to do with a weak and weakening Europe and a decelerating China. Both of these elements of the macro landscape are deflationary and are thereby putting downward pressure on bond yields. So, my big picture forecaster tip for this episode is simply this: keep your eye on the TBT ball. As long as its trend continues to roll downhill, exercise caution. With the big picture forecaster, I'm Peter Navarro from the University of California, Irvine.